Welcome to another episode of Insurance Gone Wild. I am your host, Dennis Settlemeyer, and my lovely and beautiful co-host is...
Stephanie Lencioni.
Lencioni. Hey, we are... we record these things on Tuesdays. And, mostly. And every Tuesday we get together right before this and we go, I'm exhausted. Right? Do we not?
No, seriously. You were sitting in my living room and I was like, you doing all right, man? Yeah. You doing all right?
Mondays are tough in our industry. And it's not necessarily bad stuff. It's just there's a lot to catch up on because so many of our clients and folks that are listening, you guys as a whole do a lot of stuff over the weekends, whether it be switching out cars or you had an opportunity to talk to a spouse or someone and you want to make some changes here and there.
Well, it's a lot of, like, you finally have a little free time to do I was going to look into this.
Yeah.
And then the questions come.
Yeah.
Right? So you have that time over the weekend and then the questions come.
Yeah.
Which is fine, except I think the moral of the story is please stop asking us questions. I'm just kidding. We welcome them. We welcome them for sure. For sure.
And that's something that we preach pretty much every episode. Ask the questions.
Ask the question.
Even if you don't know what you're asking, just ask the questions and try to figure it out so that you know. I think today we were going to talk. This is not normal for us. We actually have a topic today.
Only because we were told by Paul.
That's correct.
If we're being honest.
Yeah.
We were coached by Paul to say, hey, I think you should do this. And we said, okay.
That's right.
Yeah.
So I wrote down some stuff based upon
your instructions.
Paul had told me to do.
I love that.
Which is not normal that, number one, Paul would tell me to do anything because Paul is pretty laid back. But that I would be given instructions because, it is what it is. But, all right, so are you ready? I'm just going to start in.
Thank goodness I'm sitting.
I have something I'm going to read. It's I don't know how many minutes it is, but I'm going to read it.
I have time.
And so are you ready? Are you ready?
So.
All right. This is a surprise episode. Long before skyscrapers scraped the clouds, long before actuaries sharpened their pencils, long before you could insure a truck, a church, or even for me, a cigar lounge, right?
Nice play there.
There were ships.
Ships or ships?
Ships. Okay. Well, there was that too.
Okay, side
ships
note.
With a P.
And I'm not trying to throw you off, but this is what we do. Have you seen See No Evil, Hear No Evil?
I have. I love that movie.
I love that movie where they're trying to get the guy's mugshot. Mm-hmm. And she's like, okay, now tell him to look forward. Look forward. Or stay still. Or then they keep doing this and it's the back and forth. And she's like, shit. And she just like freaks out. And so the deaf
movie.
Guy who can read lips is like, is she saying ship or shit?
Yeah.
Anyway, that's what I think of every time somebody
Richard
says.
Pryor
and Gene Wilder.
Yeah. It's a great movie.
I love that movie.
All right.
Anyway, I'm sorry. That was just a side note because that's really all I have. Yeah, that's all I have.
Wooden ships, heavy with spices, silk, and dreams. Ships that set a sail across oceans that cared nothing for human ambition. For every captain who returned home wealthy, another never returned at all.
Oh, that is deep and sad.
And so merchants, worried that one good storm could erase a lifetime of work, began meeting in dim taverns and smoky back rooms, wondering how to tame uncertainty. They discovered something remarkable. If 10 merchants shared the risk of one ship, then the sinking of that ship no longer meant the sinking of their fortunes. That idea, pretty simple, pretty brilliant, was the seed. And the seed took root.
I can't take you seriously when you say that.
Centuries rolled by. Caravans crossing China split their goods among many camels so that no single bandit could steal everything. Romans collected a few coins at every meeting so widows could bury their dead with dignity. In the markets of the Middle East, travelers created a cooperative fund. Different lands, different languages, yet the same human desire. If trouble finds you today, then I will help. If trouble finds me tomorrow, you will help. What's this sound like?
It sounds like insurance, Dennis.
Sounds like insurance. Risk became risk survived, but the spark that ignited modern insurance came from fire. In 1666, London burned for 4 days. Flames chewed through timber and stone, devouring homes, businesses, and lives. 13,000 buildings gone.
Wow.
A young man named Nicholas Barbin, if I'm pronouncing that correctly, looked upon the charred remains of the city and saw not only tragedy, but opportunity. He created the first fire insurance company, assigning teams after team of red-coated firefighters to properties whose owners had paid his premium. And people noticed. If you bought a policy, you bought protection. A new business was born. Then came a coffee house on Tower Street, a noisy, cramped place where sailors bragged about storms they survived and merchants whispered about storms they feared. And the man who ran the place, Edward Lloyd, served strong coffee and stronger gossip.
There it is.
What do you think that is?
Lloyd's of London,
Lloyd's
baby.
of London,
Absolutely.
one of the oldest, if not
100%.
the oldest. Soon, his tables filled with men willing to write their names under a ship's voyage and promise to pay if the ship sank. They were the first underwriters.
The drunk people?
Yes, they were drunk. That
Yes,
explains
that
a lot, doesn't
everything.
it? That explains a lot.
Now we have answers for our clients.
Lloyd's Coffee House became Lloyd's of London, still the beating heart of global insurance, which is true. Lloyd's of London is still around. It's very good company, very strong, and they will write all sorts of stuff. As centuries marched on, factories belched smoke into the sky, railroads crisscrossed continents, and cities swelled with workers. With this new world came new dangers, explosions, injuries, lawsuits, medical bills, and for each danger, a new product: workers' comp, liability, life and health coverage, business interruption, even insurance for satellites orbiting miles above the earth. Because the world kept dreaming up new risks and insurance kept dreaming up new ways to protect against them. And yet, beneath all the policies, the forms, the deductibles, and the declarations, beneath the math and the marketing, beneath the binders and the claims, the idea of it never changed. Human beings still worrying about the same things they worried about in Babylon, in Greece, in medieval times, and in the smoky London coffee houses. What happens if disaster finds me? What happens to my family, my home, my livelihood, my dream? And so from ancient merchants to modern agents, from Lloyd's underwriters to Panatella Insurance.
Oh, nice.
The business remains the same, helping people sleep a little better at night. Mm-hmm. And now you know the rest of the story.
I don't know what that's from. But
Paul Harvey.
Oh.
Paul Harvey. So, but anyway, I mean, that's why insurance was designed. I mean, we talked a little bit about this in the workers' compensation episode, about how the Chinese or Japanese or whoever it was, they would worry about as they were crossing from island to island that bandits or pirates would come and steal their stuff. But then it kind of changed in also adding in the workers. And I think we even talked a little bit about some of the things that Europe and Germany had done to protect the workers. In the United States, whenever it was 1800s or something, had started when the 1800s, whenever it had come around, the workers had to prove more.
So I actually just reviewed this one. It's the Industrial Revolution with everything, and they had the Trinity, Trinity, where it was like 3 things had to be proven for the worker to be paid.
It was very difficult.
And one of them was assumed risk, which was the last one that you talked about.
They assumed the risk by going to working for them.
Right, and it's like, well, if this is something that was likely to have happened, and then we talked about different things, but so it definitely has. Insurance has changed over the years, but the details of insurance and the laws and all of that has changed. But I think from what you've read, the ultimate goal has remained absolutely the same. It's all about the peace of mind. I'm willing to give something up now. So tomorrow you have my back if, and then in some cases when something happens. And And that's all we want. Like, we know we can't self-insure every single thing. Maybe some people can, and that's great. But I'm here to tell you, even the richest of the rich, they've got insurance for something.
Yeah. I
Like,
mean,
they've got insurance, and like they're paying money for insurance. Maybe they're self-insuring quite a bit more than other people are, but they still have a policy.
Warren Buffett, I guarantee you, has insurance.
Absolutely. Now, does he have a higher self-insured where, hey, I'm willing to give up the first million or 5 million or whatever? Yeah, okay. That you and I can't do. We can't give up the first 5 million. But the concept is the same. It is to protect what you've built, what you have, your future, and then your family's future. Because we don't really do this. Insurance isn't really for us. Like, yes, it's for us. And if we have insurance for if something happens to us in our livelihood, but like, why do we care? Because our livelihood then affects our family. And ultimately, that's really what it comes down to.
Or how we live, or whatever it is. But
well, sure, but then that's our family. Like,
but
if you're if you're a single man going out on your own and doing whatever, you're like, man, I can figure it out. I'll figure it out. But you have a family,
and we have those kind of clients that were like, yeah, I'm not worried about if I go broke. I'm smart enough. I'll figure it out on my own.
And that's again, it's your call.
But life insurance is really for the family.
But I think a lot of it is for the family. Having responsible home and auto liability limits is for the family. Like, you don't realize by being underinsured there, if something happens, you've just hurt your family's future, because now you're on the hook for getting sued, and now the home does get taken. Correct. And this gets taken and that gets taken. Correct. Or wages get garnished, or all of these things. So this whole time that you've been busting your hump trying to make this great life for your family, it gets taken away like that from one text check while you're driving, from one sneeze when it's raining, from one, like, it doesn't even have to necessarily be your fault. Right? Like, I think about that all the time. I had to sneeze the other day. It was pouring down rain, and I was like, don't do it. Because you sneeze, your eyes close and your body kind of jerks a little bit. And I was like, it was a crazy traffic-y situation with what was going on. Anything could have happened, and it wouldn't have necessarily been my fault, but I sneezed. Anyway, I was fine. Everything was worked out. But I'm just
an umbrella policy.
I'll talk to you after this episode. No, but you know what I'm saying? Like, it's not even you being careless or you being negligent. It's just, and then add business ownership to the mix, and you've got to like it or not, but you have a target on your back from that. Like, there's just a target for any business owner out there, or self-employed person, or whatever it is. You have a target on your back for that.
Correct. Because or wrong, people think you have a lot of money because you're in business by yourself.
Correct. So anyway, that's all. I think my main point to all of that is, bottom line, I think it comes down to the whole goal with all of that from when it first started to now is still the same idea of, it's to protect my family and my future.
Yeah. And folks,
and their future.
Folks, I tell you, we talk a lot about, we do this podcast from a consumer's perspective, because we're consumers too. There are insurance companies out there that we will not do business with because we don't like the way that they do business. But you have to understand, they're in business to make money. Even those folks that were meeting in the London coffee house that ended up being Lloyd's of London, they were looking to make money. You know, long term, they were looking to make money, and they can't employ thousands and thousands of people without an income.
Okay, and right? I was going to say, and yeah. So you finish your thought, but I'm over here. I don't have a problem with an insurance company making money. You want them to make money.
You want them to make money.
You just don't want to feel like you're getting taken for granted on the back end.
Correct. Like and that's kind of where I was going, is that when you see these 20, 30, 40, 50% or 100% increases in your premium, you're like, what in the heck? I get that. I do, because I look at it the same way going, what?
Yeah.
You know, you want them to make money because they need to be able to put profits back
reserves.
in the reserves in order to pay future claims. Now, a lot of things. One of the things that people don't know is that if you have a lot, there could be. Let me back up. How can I say it? They are saving money in their account for liability claims that may have happened back in the 80s. Because they don't know whenever something may pop up because it's on a per occurrence type deal.
Okay,
And
I see what you're saying.
You understand what I'm saying?
I know. I blacked out a little bit because I got distracted.
So,
That's on me.
It's probably the tequila. But anyway.
No, I looked, it's so rude. Be present, right? Is the whole thing in life that we need to do. And I my phone buzzed and I looked at it and then I squirreled.
But
so
you get what I'm saying.
Yes.
As a former claims adjuster, you understand that you have to get the money somewhere to make the claim.
Correct.
Now, having said that, there are some, what do you call it, where you can't go back, but so many years. Statute of limitations, but not always. And so they have to keep money in, so in our area, we have a pastor of a big church that got in trouble for something he did back 30 years ago. I don't remember what it was. And so you don't think there's lawsuits and insurance involved with that?
Yeah, I mean,
30 years ago, this stuff happened.
I would say I think it would depend on the policy, right? Like I think there are
per occurrence says I have insurance now. A claim comes in, even if it was from a past claim. If the claim comes in, I may have coverage. Per claim policy says that the insurance had to be in effect when the thing, and you have to have current insurance with no gap. And so, for instance, like malpractice insurance. Let's just go malpractice.
Okay.
It could be anything, but let's say malpractice. So if you have a policy that renewed on January 1, because we're coming up to January in this particular episode, January 1, and you have a claim that happens January the 2nd.
Okay.
If you have the same insurance company on a per claim basis, it renewed on January 1, the claim coming on January 2nd for an event that happened, say November.
Okay.
Then you're going to have coverage.
Sure.
But if you have a gap of even 1 day, you're not going to have coverage.
Well, let me ask you this.
So what happens is on a per claim policy, you have to purchase a tail coverage or prior acts coverage to cover anything that happened prior to January 1.
Okay.
If you switch companies.
So same exact example. Mm-hmm. It's January 1 renewal date. Mm-hmm. And I'm not going to get into the whole, assuming there's zero gap, but at the renewal, because you have Panatella and they have proactively been shopping and then switched you to a carrier that has a better premium for you with all the right coverages, et cetera, et cetera, et cetera. So Jan 1 of the new year, you have consecutive coverage, but now with a new carrier, claims made policy, January 2nd, a claim is made for November, but now you're on a new insurance company. Is it covered?
It depends. That's
Damn it, and that's insurance, baby.
That's the perfect.
And also, I'm going to follow it up with, that sucks.
Yeah. No, if with the new policy, you purchased prior acts coverage.
So that is truly.
Then it will cover it.
Okay, but if I don't have that.
If you don't have that, then you don't have coverage.
Then I don't have coverage. I only have coverage for Jan 1 and Jan 2.
Correct.
On that new policy.
Correct.
There you go. Man, that's a whole new episode.
That is
That's a whole new episode, 100%.
It's very, very confusing. And I'll be honest with you, most people will not understand it.
Yeah, it got me.
Because it's very confusing. And whenever I look at, so it happens with contractors a lot. Contractors will buy policies. Claims made policies are usually very inexpensive.
Well, sure, because
it's year to year.
Your liability is literally in this very defined spectrum.
So there are companies out there that sell a lot of claims made policies for contractors.
Why? Because they want
Contractors-
the sale. They don't care about the coverage.
Contractors don't understand the difference between claims made and per occurrence. And so they go with the claims made. Well, heck, you were $2,000. They were $2,000 cheaper. Something with that. Yeah, but all that prior work that you've done is not covered.
What if?
What if something...
And that's the whole thing with insurance is the what if.
Yeah. So when you look back at the history of insurance, they figured this stuff out. Hey, why are we on the hook for something that we weren't even insuring at the time?
Yeah.
And if we're going to insure it, we want more money.
Hell yeah.
So the premium's higher.
Makes sense.
Now, it takes about 3 to 5 years for the premiums to
level out.
Kind of level out between claims made per claim and per occurrence.
Well, sure, because then the likelihood of something happening 30 years later
is very small, but it can happen.
Sure. I think it's
could happen.
Fair to say that anything could happen. But I do think in most cases there will be some form of statute of limitation that gets,
or there's an endorsement on the policy that says we only go back so many years or whatever.
Sure. Like 30 years, I feel like is a real, like nobody can really.
But there is money on the books going back for stuff that happened in the 80s and the 90s, and so they have to keep. Obviously it shrinks. It shrinks how much they're having to keep. But it's there. They have to keep it there.
That is the only, I think that's the only job I've not had in insurance.
Actuaries?
is being an actuary. So no, that I don't know. But I do know doing claims.
I would not want to be an actuary.
Well, no.
I don't think like they do. They,
actually, I wouldn't mind if it's just getting drunk in a coffee shop. Then I'm kind of down.
Well, there you go.
Like call this a coffee shop and let's call it good.
Yeah.
But when I was doing claims, when I was on my way out, they were really cracking down on, you have to make sure. So when you get a new claim in, you set the reserve. Mm-hmm. You have to go in and the adjuster goes in and says, okay, well, based on the information from the call in, right? The claim call in, which is hey, I was in an accident, whatever, basic information. Basic information.
It's going to cost about this much to settle it.
Yeah, like you get,
it's an estimate. Based on history, based on experience, whatever.
Yeah, talk to the claimant, all the things. You're like, okay, I think we could get out of this in about 5,000, whatever. Or something happens, you're like, lots of zeros. But because at the beginning, it is all an estimate, and they do have a default. They have a default when claim first comes in.
Broken arm is worth X amount of dollars.
But they were really cracking down. They're like, you've got to get, like, we all know, because there are like it or not, there's always a value to the broken arm or to this or to that, and it does vary based on, did you break the arm of a surgeon who's highly paid or a warehouse stalker? And I'm not saying that there's any right or wrong, better or worse. I'm just saying there's a difference in pay. Just whatever.
I think this, I'm going to interrupt. I want you to finish your thought.
Yeah.
But this could be an entirely different episode for.
Yeah, I was just going to say, that's important though. The whole thing is that they were understanding, like, we have got to have accurate reserves on file, because that affects bonuses, that affects raises, that affects how many people we need to hire, that affects how many people we can hire, that affects premium, that affects types of policies that we now have to adjust to make sure.
Loss.
But that's the thing, because how often do companies change their policy and the coverages that they're willing to give? Because if they continue to get their butts kicked on a certain coverage,
they're going to try to get rid of it.
They're either going to try to get rid of it, or my God, you're going to pay through the roof, or, so anyway, it just makes sense. The whole reserve thing is, there's a lot, to your point, there's just a lot that goes into it. There's a lot.
And but going back to the beginning of the episode,
sorry about that,
is that it's about the history of insurance that has been learned.
Squirrel.
That has been learned by the insurance companies over the years.
Yeah.
And now I want to bring up something that was a sore subject for us that we disagreed on, but we were actually agreeing on. It was the AI portion, analytics with AI. It's like, okay, they're going to start putting more and more AI in. But they've been doing AI type stuff for a while. They just didn't call it AI. Automated or analytics
just,
or something like that.
Yeah.
But now it's going to be, they're going to call it AI. Our AI models say that blah, 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 whatever it is. So, we're going to see some changes in the industry. We're already seeing changes in the industry. I mean, we got parametric programs now. What's a parametric? Well, we have programs that we can offer people that's based on like wind, hail, tornado coverage only, based on, the National Weather Service, the National, what's NOAA, whatever that is.
Oh, we talked about that, but I don't know.
Yeah, but I mean,
it's
based on a number of different organizations that collect this data on storms and damages and things like that. That's different than regular insurance. It's called parametrics coverage. And so it's growing. That particular segment of the industry is growing. And so we have that, and we can offer that to people to help them, reduce their risk on a hailstorm on their roof, so to speak, especially in North Texas. Hailstorm on the roof, or maybe some other state that has a lot of hail or snow or something along those lines. But anyway, there are new products that are constantly being created.
Right.
But it all goes back to insurance was designed to spread the risk out. The dollar amount of risk out.
Yeah. So it's twofold: to spread out the risk, but you spread out the risk and people are willing to pay into it because of the peace of mind provided.
Mm-hmm. I agree.
So now, I just think that's the important, because if I don't care, well, that's fair. I literally have people who are calling me every day and they're like, so I'm wondering if you can help me, but also I think I'm just going to go uninsured with health insurance. Mm-hmm. Like, I think I'm just going to risk it and I'll go to the hospital if something happens. I'm like, that's super cool until you get a diagnosis where you need treatment and they will not treat you until you pay cash up front. Let's find an alternative. But at the same time, but it is, to your point with that, all I was saying is that it is getting quite expensive. And it's getting expensive from every angle. This isn't just, it's not like, gosh, homeowners insurance is really going up these days.
Yeah. Well, it's not just insurance. Let's just say that.
Well, fair. I was going to say.
We've talked about the price of eggs versus the price of steak. I mean, eggs were at one time $7, $8, $9 a dozen. Uh-huh. Now they've went back down, but they're still not 50 cents a dozen like they used to be.
No. Well, and it can't be because you have gas and you have this, and there's a lot of other costs that go into it. But, yeah. And I was just going to say, like, it's not just one vertical of insurance, but to your point, it is literally everywhere you turn. You turn around, and clothing to put on your family is more expensive. Mm-hmm. The insurance part is more expensive. My God, water and gas is more expensive. It's just the utilities stuff alone, right?
Not so much gas at the pump. It's
no, not that gas.
Texas
no,
anyway.
I'm saying I mean like utilities in your house, in your home.
Yeah.
It's nuts.
My water, sewer, and trash bill just keeps going up.
It just keeps going up, and you're like, well, that's weird. I'm not giving you any more trash.
Yeah.
But that's cool.
I can if that's what
yeah, you can earn it.
Yeah.
But
hey, folks from the other city, bring your stuff over and set it on my curb. Let's make it worth everybody's time.
But so to your point, it is everything.
My wife and I have talked about this a number of times. It's a bubble, and eventually the bubble's got to pop. And when is the bubble going to pop?
Man, you would think that they've been saying that about education for the longest time, and you'd think it would have popped by now. Mm-hmm. Where the school that I went to, my first college, I think it has doubled in tuition for 1 year. Doubled.
Yeah, I think higher education.
Now it is a private school.
Don't get me started on higher
but
education, because those folks sit there on trust and all sorts of things that have got millions or hundreds of millions or billions of dollars in it, and they're still charging students some crazy amount of money. Not all of them, but some of those big ones, those Ivy League, especially those Ivy Leagues, they got billions of dollars in just sitting there in reserves that they could tap, and yet they're charging people whatever they're charging them per semester.
Because they can.
Because they can.
But to be fair, I'll say,
And they're paying professors that are like from the government. I don't care what your religion, your
Political
Democrat,
views,
Republican,
yeah.
political affiliation, but they're paying Hillary Clinton $500,000 a year. It's like, where are they getting that money? They're
And
not pulling
yeah.
it from that
And also,
big
How
bucket
come?
of money.
like, also, how come? Like, what? Why?
Yeah.
Justify it. Justify the $500,000.
So you run into that with insurance too, though, right? Where
You do.
you scratch your head going, what the heck are they doing? I mean, we as agents look at it and go, this doesn't make any sense.
Yeah.
But yet you have our marketing reps that have been fed. They got jobs. They got families. I get what they're
absolutely.
at. They've
They're
got
drinking the Kool-Aid.
They have to drink the Kool-Aid, right?
Yes.
But there are agents like us that sit out there and go, yeah, no, that's not right.
Doesn't make sense.
Doesn't make any sense.
We can't justify it to pass that on to our clients.
Yeah, so we're not selling your stuff.
Right. Well, and then you do have some, and I feel like we've squirreled quite a bit. And then what I will say is there is also a cost to the marketing aspect.
Mm-hmm.
So when you have Patrick Mahomes and all of these other
Aaron Rodgers,
really
discount,
famous
double
people,
check.
right? But all of these really famous, high-priced people, that's fantastic that they're out there representing your company. But guys, understand the cost is coming from somewhere. They have to pay them somehow. So that's in the marketing strategy. So maybe they're not popping up on your Facebook feed.
The number
but
that I heard a few years ago was that Progressive spent over $1 billion in marketing.
that's nuts.
Over $1 billion in marketing.
And you kind of want them to stop now because we know. But out of sight, out of mind. So do they fall to the wayside if they stop marketing?
Yeah.
And I will tell you, I don't like a lot of the companies that we see online, like in commercials and things like that. And I'm like, oh, I hate that company. Blah, 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 blah. But I have to tell you, insurance commercials, some of the funniest damn
agree.
commercials. Like,
Yeah.
I'm sorry, but emu, like when the guy is running across the football field and gets tackled, I mean, that'll make you smile any day of the week. You know what I mean?
Yeah, no, I get it.
I mean,
So
emu.
insurance was started to help spread the risk across multiple
Sure,
people so that
bring it
nobody
back.
was out a ton of money. And it's really still that basic foundational principle. We call it now the law of large numbers, where people will say, I'll just insure my home myself. Well, if you've got a $500,000 home, do you have a $500,000 to insure it yourself? Or would you rather pay $4,000, $5,000, $6,000, $7,000 to have an insurance company take care of it? So you're not out a $500,000 if it were to burn down.
Also, I would like to pick out the details on that is that you, with the $500,000 of self-insuring, you haven't replaced any furniture. You haven't replaced any silverware. You haven't taken into account the cost of living that you have to have while you're rebuilding and
That is
doing.
a great point. Let me make it a little more basic. Your point. The $500,000 is just the structure, not your stuff.
Not your stuff and not your living in the process of your home being rebuilt.
But insurance is still essentially the same foundational principles.
Correct.
Now, there are companies out there that take advantage of that and try to make more money than they probably should off of it.
We'll call it bad
I
faith.
shouldn't say should. They just make more. They try to make more money than other companies. And overall, now sometimes you're going to have a really good company that's going to be higher for a particular person than others. But that doesn't mean that they're trying to take advantage of everybody. It's just that there was something about this particular person they felt it was going to be a larger risk.
Well, no, but they may be, what do you call it?
I don't know.
Like overpopulated in that. What's the word? Where they have too many people in that area where they're like, I really don't want to add another person.
Exposure.
Yeah, too much exposure. It's not the word I'm looking for, but like it's higher. They already have quite a
Liability
large
exposure, property exposure.
Yeah,
so
but
it's
like they already
exposure.
have quite a bit of people in this area, and they're like, I mean, I really don't want to take on another guy because if this area gets hit with hail,
True.
like we're about to get
they base it
slammed,
on
and
zip codes.
so what they're saying is, it's kind of like. And Fort Worth does this now. A lot of places in the country do it where it's like parking, something as simple as parking. You go down to whether it's West 7th or you go down to downtown Fort Worth or whatever. But it's like when you pay to park, it's all based on how many open slots are there. So it's what do you freaking call that?
I know what you're talking about. It's yes.
What is that thing? My brain. I have a little bit of a cold, so my brain's not working so fast. Need and
Availability.
No, but like what's the sales where it's like Paul. It's like when you like demand, supply and demand. Christ, that's terrible. It's supply and demand. So you have a limited number of spots available. So that's your supply. And then the demand is, well, how many do we have available? And then what time of day is it? And all of the things. So
it's actually the other way around, but I understand what you're saying. Supply is how many we have available.
Yeah.
Demand is how many people want it.
Okay, thanks. Yeah, love that. That's a good, thank you. So the supply and demand of it, where like in Fort Worth, depending on when you go and then how many people are already there, your parking cost is going to be varied based on the supply and demand.
Well, shoot, the 183 tollway does the same thing. How much is it during the middle of the day, the 183 tollway?
I don't do tollways.
Okay. The 183 tollway during the middle of the day might be $1.50 to go from quite a ways.
Yeah, here to Oklahoma.
But during rush hour, it may be $10, $15, $20.
See, that's crazy. Yeah.
Yeah.
That's that's where I'm saying with insurance, it's not necessarily them saying some of them are pricing themselves out on purpose where they're not saying, hey, we're closed to this market, but they are telling you, I mean, okay, if you're going to be in here, you're going to pay your premium because we're tapped out. Does that make sense?
Yeah, it does.
That's all I'm saying is that sometimes it's not out of bad faith. It's not trying to rip off the client. It's not trying to do any of these things. It's just saying, hey, I'm so sorry, but you just came a little bit later to the party than the last 2,000 people that joined us.
No, the company we used to both work for did that a lot. That's where I learned that. It was based mostly off zip code.
Yeah.
And they're like, yeah, they would tell you, this particular zip code, we don't want any more people.
We don't want any more people because it's saturated is the other word I was looking for.
They couldn't turn it off because the state wouldn't allow them to turn it off. But they could price it higher to go, yeah, that's not what we want. So now we'll take the zip code next to it, but not this particular zip code. So that's a good thing about it being an independent agent, an independent broker, is we can go, hey, this company doesn't want you, but this company likes you.
Yeah, not right now, but we can try in a year.
In 2 weeks, 2 years, I mean.
And and that's the same thing with apartment shopping. You think about that. Like it's all about timing. How many apartments do they have available? How many of the model that you're looking at do they have available? How many? It's all about supply and demand, and then the saturation. Well, we're done.
We got way off subject.
I know. Most of that was me.
I tried to bring it back a few times, but Stephanie just kept talking and talking and talking.
I was going to try to be quiet today too because I have the sniffles.
She has the sniffles.
I have the stuffy nose.
But yeah, we got way off track. But going back one more time, the basic concept of insurance is still the same. Divide the risk up amongst multiple people. Matter of fact, 10 is an interesting number. A Lloyd's company, if you have a Lloyd's company, they are not supposed to have any more than the dollar amount of premium they bring in is supposed to be equal to or less than their exposure. So if they bring in $100 million, they're not supposed to have an exposure more than $1 billion, or 10 million more than 100 million. That's a Lloyd's company. That's how that works. So,
okay, that's probably why they've been so strong for so many years.
Yeah, well, anybody can be in a Lloyd's company. That's just rules you have to abide by. And whenever you get into
but how many have we seen come and go?
Oh, a lot.
A lot of within them, 2-3 years.
There's tons of Lloyd. Almost every, I shouldn't say almost every, but a lot of major companies have different policies that they offer, and some of them are based on a Lloyd's program.
Interesting.
Versus an exchange. An exchange is something completely different, which the company you and I work for had an exchange where they charged management fees. And that's different. But we were not going to get into all that. It doesn't matter because if we're doing it from consumers' perspective,
they don't care.
Consumers don't care.
We care about the price tag.
But
what's covered,
as
what's
agents,
price.
We're interested. So anyway, listen, thank you guys for joining. We've had a good time. So we got way off subject today, and we do realize that, which is typical of us, right?
Yeah, that's on me today.
Yeah, but it's on you today, not me.
It's on me today.
Not me.
Yeah.
Usually it's on me.
Yeah.
But not today. So, but if you have questions, comments, reach out to us, contact at igwpodcast.com or give us a call, 817-753-0093. We'd love to hear from you. Comment on through our YouTube channel, Instagram, Spotify. I guess you can, Paul, can you comment through Spotify, Facebook, whatever your Podbean, however you're reaching us, listening to us. If you have questions, comments, reach out to us. We'll be glad to try to answer those for you. Thank you so much.